What's up, tribe? So in this video, I'm going to show you or explain to you about accumulation and distribution. You'll be hearing that in trading. Now, there's also another one called manipulation. Manipulation is just the feature, you could say, as the feature or the characteristics of of accumulation and also uh distribution. Okay, so let's dive deep into that. Okay. So accumulation and distribution was first introduced by a man called Richard Wyckoff. Right. So this was the theory called the Wyckoff theory. So the Wyckoff theory is a set of rules that allow traders to understand institutional players. It allows traders to see the footprints of smart money and to trade on the same side as those with the most influence over the market. The law of supply and demand is the core principle of Wyckoff's theory. So essentially, this area right here is where big institutions are uh, gathering orders, right? They're accumulating orders. They're stocking up liquidity to push price to this level where sellers are going to distribute. So they are accumulating positions around here. So the market moves in waves. Okay, it moves in waves and it moves from accumulation, distribution, reaccumulation, distribution, and so on and so forth. Okay, so where it is in accumulation, it is also known as oversold. Now it pushes out of the accumulation area. Now this rally is called the markup, right? This is where demand is greater than supply. So it gets to the distribution area, which is called the overbought. So this area is where we are anticipating for sellers to step in and move the price down, which is called as markdown. So this area is where supply is greater than demand. Okay, so this creates a wave-like structure, a wave-like movement in the market. Okay, now let us look at uh the the reality of this wave. Okay, the more visible and more realistic view of the wave. Okay, so you can see that now uh the balance where the market is accumulating or distributing is where supply and demand is at an equilibrium. There's a balance between supply and demand. When there's a balance between supply and demand, there tends to be what? An accumulation or distribution. Okay, so here the market is in a balance. Supply and demand is in an equilibrium. Okay, so it distributes down to this level where it's accumulating again and then pushes to this distribution again and then pushes down again, accumulates again, and then pushes out to distribution. So it just goes on goes with this wave, right? Accumulation, distribution, accumulation, reaccumulation, distribution. Okay. So you can pause the video to read this. It's just a way of linking both Wyckoff theory with supply and demand. You guys know that I trade supply and demand. Okay. So what is the accumulation? So accumulation phase usually presented as ranges. The accumulation phase represents areas where large players accumulate their position to go long before the market uncovers its direction to other traders. Okay, this is the accumulation here. So this area is the accumulation phase. Then the markup occurs when big players have accumulated large enough positions and start to bid the price up to encourage other traders to jump in and push the price even further. The markup phase causes the price to rise out of the normal range, starting an uptrend, which is seen as imbalance. Okay, this is seen as what? Imbalance. Imbalance. This is where price moves out of the equilibrium, out of that accumulation or distribution. Okay. Say now distribution is opposite of the accumulation. So once the price reaches the desired level, large players begin to sell, which is distribute their positions and bid up shorts. Markdown is the opposite of markup. This phase refers to the price moving down. In other words, is the opposite of the markup phase. Okay, with financial institutions pushing the price down, encouraging other traders to go short and start a downtrend. Okay, so this is here. This is it here. Mark up, mark down. Okay, so this is the schematics of the Wyckoff theory, the Wyckoff logic. So essentially, you would have this where the market moves and creates this selling climax, and then it ranges for a while, right? And it manipulates. So there's low volume here, and then failed sell off. So it goes back to that range, stopping some traders here. So it takes absorb all the sell orders here. Like I told you guys on previous videos where I spoke about liquidity, and liquidity is always sitting at highs and lows. Okay, so this is one high and low, and you can see that double or triple bottom here. So it came out what pick all the stop losses sitting around here, and then goes back into that range, right? And then breaks that range. Okay, and once it breaks that range, we will confirm that what this market has accumulated and is now rallying toward to the distribution. Same thing that happened in accumulation will also happen in the distribution phase, right? I can see the markdown right here as well, right? Okay, so let me show you that on the chart. Right, you can see the accumulation, you can see the manipulation right here. It came here and took stop losses that were sitting around here. Okay, let me clone this. Our same thing here. It took stop losses that were sitting around here. And then once it took those stop losses, took some orders here, right? And then it starts what rallying up and then goes toward distribution. So let me show you that on the chart. So you can see that on the chart. So I've already marked that for you here. Okay. So this is a typical example of, you can see market started from here. This is a Bitcoin accumulated here. You can see it was in a range for a very, 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 very long time. I would say this took like 223 days and 16 hours to accumulate. This is on the 4-hour time frame. Okay. Now once it accumulated, then what? It pushed price. The buyers pushed price out of this accumulation zone, and then made a new high. Okay, and then it distributed for a while, and then dropped down and what accumulate. So once it accumulated, what it pushed again. Okay, so this is how price moves. It accumulates, distributes, accumulates, distributes. Now you will not really see this. Let me show you something. Let me if I can get that. You will not really see the market do something like this. Right? Because the market is very chaotic. There are so many cycles within a cycle. Okay? There's so many cycles within a cycle. So we can have smaller cycles here like this. You could have maybe another cycle like this. Right? So the market moves from cycle to cycle. So the market could do like this, accumulates here like this. The market rallies to join this cycle, accumulates here, and then drops and comes to this cycle, right? And then drops more to this cycle here, and then rallies here again. Sorry, it rallies here again, and then drops to this cycle, right? And then accumulates here, and then rally, and then distributes here, and then comes here, right? Because see, these all cycles are converging, and then accumulates here, and then it could rally here, right? So this is how the market will move most of the time. So now if I take out this sine wave. You see how the market moved. So the market moves from cycles to cycles. Now, if I change this my candles, where will I change candles? Okay. So if I change this candles to line charts, you can see how the market is moving. All right. Same thing with this one here. So market moves in waves, and it moves from cycle to cycle, and that's why you see the market is very chaotic. But still, you can still spot accumulation. I will say this is demand zone, right? And you can spot distribution, right? Where sellers want to sell the price, then you could say this is what accumulation again, right? And a tiny distribution here. Okay, the market rallied, you see, came back here, maybe distributed again here. Okay, then came back here again. Let me clone this. Right, accumulated here. Okay, so the market is what making these waves, making all of these waves. So this is how the market moves from wave to wave. Okay, so this is how you can spot accumulation and distribution in the market. So you want to know the phase the market is at any given time. So let me look for another example. I think I did one on Ethereum. Okay, so this is a typical example. So if we go back, okay, I'm going to switch this back to candlesticks so you guys can. Okay, so this was the accumulation, right? Price accumulated, pushed out of the accumulation zone, distributed, made a tiny accumulation here, pushed here, distributed here, came down here, accumulated again. Now, some accumulation could take time because, like I told you, as I said in this video previously, that market can be in a cycle for a long period of time. For a long period of time, it could accumulate for a long period of this. Now, this particular one took how many days? I'll say this took 98 days to accumulate, and then it broke out of that accumulation. And where did it went to? It went to this distribution here, right? You can see then it started rallying down. So it started dropping down, declining down, they accumulated again, push here, reaccumulate again. Okay? And then goes to this area here. So the market moves from cycle to cycle, and we use the Wyckoff theory to able to spot where or which cycle we are in the market. So once you understand this, you can understand when not to take a trade, when to join the trend, because once market breaks out of this equilibrium, we are looking towards, we're looking to jump in on the trade. Now look at this one right here now. So let's say you saw where markets swept this liquidity here. Okay, market swept this liquidity here. Now, imagine market swept this liquidity. You could see that this market has been ranging for a very long period of time. This ranged for 54 days. So now, immediately it broke this high, and it swept this liquidity here. You know that this market is about to trend. So you could look for opportunities sitting around here. Maybe there could be opportunities sitting around here. Okay, you could find opportunities sitting around here. Okay, so if you trade the breakout and retest strategy, so once price breaks out of this, you are looking towards, you are looking to buy. So where would we're going to put our stop loss, our entry. So once market breaks out of this, wait for that tiny what, that pullback. So market made that pullback here. Let me show you. So this was uh the previous zone, right? So market came, made that pullback here. Okay. So this is for those that trade the breakout and retest. So market made a retest, a pullback. Once it broke this swing, you are looking for it to what, to break a swing after a pullback. So it didn't make that retest here, but it broke this previous high here, made the pullback break the previous high here. So if you want to enter on the pullback entry, you could enter here, something like this. Sorry, and then you put your stop loss below uh below the pullback, right? But if this was close to this zone, you could just put a stop loss here, and maybe you could target uh 1:2. Okay, very simple trade. You could do the same thing for other. Now, these are for those that trade the Wyckoff theory. I also trade the Wyckoff theory, but Wyckoff theory is very complicated. You need to add it with other strategies. You know, bring out more confidences before you trade the Wyckoff theory, right? So I also add the Wyckoff theory with my supply and demand, and that gives me uh, very good win rate. Okay, so that will be all for this video. If you are interested in me teaching you one-on-one session or mentorship session, then you can go in the description. You will see a link. Click on the link. You can join our free Telegram. I share insights, strategies, tools, tips, and also signals as well. So see you guys on the next video.